And welcome to our webinar. Tonight's class is Moving Average Convergence Divergence, or MACD as everybody calls it, which is one of the leading indicators that are used for especially Forex trading, CFD trading, and it works great for futures or the commodities market or the stock market. Tonight's class is sponsored by Prime. That's from ADS Securities, and their website is called Prime. They are one of the world's leading online brokers offering unequaled service, support, education, and trading. They have multiple platforms. They are regulated throughout the world, so anywhere you can access their platform, they are regulated. As you can see, they have offices in Hong Kong, Abu Dhabi, in London, throughout Europe. They are one of the largest, most respected brokers out there today. All your funds are segregated, so you know that they're safe when you trade with them. And they have the most advanced, fastest platforms. You can trade indices, currencies, commodities, shares, metals, treasury bonds with Prime. So give them a chance if you're looking for a broker. Now, you can, while we're in class tonight, you can go to their website and open a demo account, or go scroll through and see all the tools and everything they're offering to you, while we talk tonight about moving average convergence and divergence. Now, let's start off with a bit of history. The indicator was developed by Gerald Arpel in the late 70s. So when it was developed, we didn't really have Forex trading or CFD trading. The rather grand sounding MACD, Moving Average Convergence Divergence Indicator, and I actually like saying that, Moving Average Convergence Divergence, is actually one of the most commonly used momentum indicators around. Remember that word, momentum, because you have indicators that give you volatility, you have indicators that give you overbought and oversold, and you have indicators that give you momentum. Momentum is very, very important. It is used to spot changes in the strength, direction, momentum, and the duration of a trend of a stock price or any asset. The MACD is one of the most popular and broadly used indicators for Forex trading. The letters MACD, the abbreviation for Moving Average Convergence Divergence. Like I said, I like saying that. The MACD indicator, which requires moving averages as input, falls into the group of what's called lagging indicators. We have leading indicators, we have lagging indicators, we have oscillators, we have bounded and non-bounded. Okay. MACD is what's a lagging indicator. It lags slightly behind the market. The basic function of a MACD Forex indicator is to discover new trends and to help identify the end of a current trend. There are also various ways to gauge the signals generated by MACD. And many traders use their own unique settings and methods around this trading indicator. Now, trading divergence is a popular way to use the MACD histogram. And we'll explain it to you in a minute. We'll show you exactly how to create it. But unfortunately, the divergence trade is not very accurate. It fails more than it succeeds. To explore what may be a more logical method of trading the MACD divergence, we look to using the MACD histogram for both trade entry and exit signals instead of only entry, and how currency traders are uniquely positioned to take advantage of such a strategy. Now, understanding MACD. The MACD indicator is typically placed on the bottom of a trading chart in a separate window beneath the price chart. So let me pop you over and show you on a real live chart. MACD, hold on a second, let me pop the one on the screen. Okay. So as you can see, just wait for the next chart. As you can see, this is the chart we're going to be using tonight. This is the Euro US dollar current chart, and the MACD is placed below, or the indicator is placed below the chart. You don't place it, it's where the charts automatically place it, because you have certain indicators that go over top of the price chart like Bollinger Bands and others that are placed beneath it. Now, MACD is a very popular indicator, and therefore is readily available. You don't have to do any of the calculations. You just come up to any chart and go under indicators, and you scroll down and look for your MACD offering, and we just simply click on MACD, and it's going to add it to our charts. So I've got two of them up here, so because I had the one that was here first. Now we can customize these a little. I've made the colors very bright and very easy to see. Now we can see on the MACD histogram, the MACD indicator, we have three vital, they're not lines, two lines, and one is a histogram. A histogram are these this little chart with these lines up and down. Okay, it's called a histogram. It's the lines and their calculations. And we also have the two lines, the gold and the yellow, which are just colors I've selected. I just selected these colors tonight to make it more easy for you to see. But some of the charts use standard colors. Some give you the option. It doesn't make a difference what color. I make them just easier for me to recognize and understand. So basically, we can go here on our indicator, and you can see that we can, I've just adjusted what's called the histogram, which is what we put in blue, the MACD line, which is in red, and the signal line, which is in orange. Okay, now we're going to go through each one of these tonight so you'll understand what the calculation is for each one and what they're used for. But these are the three pieces of information that are on your indicator. Okay. And like I said, they go below on your chart. Now, because MACD is so popular, we also have many apps and many add-on features that will actually do all the MACD calculations, not just put it on your chart. But if you notice here, we can go up here to MACD and ask for the standard MACD strategy, because there's part of a strategy that's built in here based on the values being higher, low, and divergence and convergence. And we can just click on there, and we can see that now it's been added directly onto our chart. So each place that we get a crossover or we get a break above or below the zero on the histogram, it's put it right on the charts. But you don't need to use it. You can do it yourself. But if you notice where we have the reds and the blues on the charts, they coincide with crossovers of the two lines on the chart, or convergence and divergence. Here, 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 here. Okay. Now, granted, right now you don't need to know anything about this, but also with the strategy advisor, we can see based on the strategy exactly what profit we would have made on these trades as it goes, and then you can adjust the strategy to fit your own type of performance or your own type of automatic indicator. This is one of the things that advantages to TradingView.com charts. But that's besides the point. That's not about using MACD. It's just about using a strategy. So let's go back to my PowerPoint. Let's talk about where these three lines come from, or these three pieces of information come from, and how we would use them. So let me pop my PowerPoint back up here for you. Okay. So as I said, okay, the MACD indicator is typically placed at the bottom of the trading chart in a separate window. Since it's placed on a chart, what does it make it? It makes this technical analysis. Okay. The concept behind MACD is fairly straightforward. Okay. Let's not make it more complicated, because you don't have to do any of the calculations. Essentially, it calculates the difference between instruments' 26-day and 12-day exponential moving average. Okay. One of the two moving averages that make up the MACD, the 12-day EMA, is obviously the faster one than the 26-day, which is slower. Now, for those of you who don't know what an EMA is, or an SMA is a simple moving average. So if we were to use in anything, forget MACD, a 10-day moving average or a 10 time frame moving average, okay, we would take the last 10 numbers, add them together, and divide by 10. And so if we had gold trading at 1200, an hour ago, 1200 now, 1200 2 hours ago, 1200 3 hours, and we would take all those 1200s and add them together and then divide it by 10, we would get 1200, and that would give us the average price of gold. Okay, in that 10, and we refer to it as 10-day, but it's 10 time frames. Now, an EMA is a exponential moving average. Basically, it gives a little bit more weight to the most current time frames. So in other words, if gold was 1200, 1200, 1200, we add it all together, we get to whatever 1220,000 divided by 10. Well, in this case, we might say that the more recent gold would be given 1.10%, and the oldest 10-day gold only weighed 0.90%, because we give more weight to the most current number. Now, guys, you're all typing in a million questions. Why don't you sit back and listen to the class, and we probably will answer those questions. Because if I take everything out of order to answer your questions, we'll never get past this page. Okay. Now, the reason we use a 26-day and a 12-day exponential moving average, can anybody tell me why? Because when George Arpels developed MACD, this is what he used to develop it. Now, you can change it to a 14-day and a 96-day, but then it's no longer the standard MACD calculations or the standard MACD strategy or the standard. You have to then create it, test it, back test it, verify it, and then it becomes Bill Smith's MACD. Okay. So when George Arpels developed this and he tested in the markets, he came to test it and verified it, and for what he developed, and he was the developer of the MACD, was that 12 and 26 worked best in the marketplace. You can adjust it and change it to anything you would like. But then none of the rules hold true, because all the rules all hold true for 26 and 12. It's no different than Bollinger Bands. It's no different than RSI. There are standard calculations based on what the originators developed this at. You might go read in the internet or find a video on the internet with somebody who's developed a whole trading strategy using a 90 and 142-day move. You want to learn his strategy, that's fine. But it is not the standard strategy, and therefore you have to then test it, retest it, and come up with your own conclusions. In the calculation of the values, both moving averages use the closing price of whatever time period is measured. Okay. So if we're using the 26-day exponential moving average, we would be using and we're working on a 15-minute chart or a 1-hour chart. Let's just say tonight we're hypothetically working on a 1-hour chart. Okay. Because MACD works, but if it will work, because if you understand what a moving average is, it's using, if we're using a 12, and we say day because it used to be just day charts, but that would be 12 time frames. So if we're using a 1-hour chart, that would be the closing price of each hour for the last 12 hours. Okay. If you're using a 15-minute chart, what would it be? Be the closing price for the last 12 15-minute periods. Okay. So both moving averages use a closing price of whatever period is being measured. Okay. On the MACD chart, a 9-day EMA of the MACD itself is plotted as well. Okay, so this gets a little bit odd, but once we've calculated the MACD, then we average out that MACD. So we're using a 12-day, a 26-day EMA to calculate the MACD, and then we're using a 9-day or 9 time frame variation of that MACD itself. So we calculate the difference between the 26-day moving average or the 26 time frame moving and the 12-day moving average. So if we were using gold, and gold was 1200, 1200, 1200, so the 12-day moving average was 1200, and we were using gold back to 26 days, and 26 days ago it was trading at 1250, 1250, 1250, 1250, then it dropped to 12, 12, 12, and the moving average over that period, that 26-hour period, was 1218, say. We would take the difference between the 1218 and the 12, and that would give us what? 18. So that would give us a MACD at 18. Then we take, so that MACD is for this time period right now. Okay. So if we went on our chart and went back 9 of those time periods, and so we had 18, 17, 15, 14, 12, 19, we would take those and add them together and divide them to come up with a 9-day MACD. Okay, so on the chart, on the MACD chart, a 9-day EMA of the MACD itself is plotted as well, and it acts like a trigger for the buy and the sell signals. So let's go back over to the chart and let's see this on the chart. So what we see on, let's get rid of this MACD indicator. Where's my off button here? Oh. Okay, so on the bottom here, we have the MACD line. So as we can see, the red line is the MACD line. Okay, what is the MACD line? This MACD line, the red line here, is the 12-day or 12 time period, 26 time period differential of the moving averages, and it's smoothed out with a 9-day moving average of that total. So we can see that line moving up and down. We don't really care what number it is. To plot it, we care what a number is. But now we have on our chart, because we're going to be looking at the relationship between this MACD line and the MACD signal line, which is the orange line. So right now, all we've got is this one line on our chart, right? It took several steps to get the one line on our chart. What did we do? We started out by taking a 26-day EMA and a 12-day EMA and calculating the difference between those prices. Then we took a 9-day average of those prices, and that gave us the line that we put on our chart, or the dot we put on our chart. And then we connected all of those dots together to form our MACD line. Everybody with me? I know it's a little bit complicated, but since you're not actually doing the calculations, you're not that concerned with it. But it is a 26-day EMA minus, or the difference between a 26-day moving EMA and a It's a difference between a 26-day EMA and a 12-day EMA. Then that is averaged out over 9 days. Okay. From there, we have to go to our signal line. Maybe it's easier if I take you back to PowerPoint and I show you my opening slide again. Hold on a second. There we go. So as you can see on this chart, on this sample on the right, we have on the chart, we have the 12-period EMA and the 26-period EMA. That's the purple line and the black line, which are the moving averages. These become the MACD. That MACD is then smoothed out the difference between these is then smoothed out to form the 9-day EMA of the MACD. So the MACD is the difference between the 12-day and the 26-day, and then that is averaged into a 9-day, and this gives us the red line on our chart. This is our histogram, and this is our signal line. Okay. So now we have to learn the signal line because the histogram is the difference, okay, between the MACD and the MACD signal line. So it's the difference between this line and that line gives us the histogram. Everybody with me? Okay, guys, you're asking me questions I've already answered for you. Okay, if you want to know exactly what the term EMA is, an exponential moving average, go use your little fingers, go into the internet and look up EMA. Okay, because it's just a standard mathematical term and you have to look it up and read it. Okay, now I've also told you, and I'm just answering all the questions, I've told you over and over and over again, you don't have to worry about the calculations because it's all done for you automatically. Okay, again, how to calculate the EMA. Okay, EMA is a standard mathematical term. Okay, it's not something created just for MACD. If you don't know what an EMA is, a weighted moving average or a simple moving average, just go into the internet and put in Moving Average Forex and look up the definitions, and they'll spend to give you videos and everything else to explain them. Okay, so let's go back on because we have a lot to cover and not much time left. Okay, because we're spending too much time on the calculations. Now, okay, so now that we've done the calculations to come up with the MACD line, we have to then move on forward and, okay, the MACD generates a bullish signal when it crosses above its own 9-day EMA, and it sends a sell signal when it moves below its 9-day EMA. So the moving average convergence indicator is both a momentum oscillator and a price-based oscillator, and it is one of the most reliable studies that we have. While it is, and I'll reiterate this again for those guys who keep asking this, it is a lagging indicator. It works well in all time frames and with all stocks and futures contracts as well as your audio's gone out. Let's see if we can do. Guys, the audio's gone out, but I'm trying to... I think I've got audio back again. Can some of you guys type in and let me know if you're hearing me now? It seems like I've been able to get it to reconnect. Give me 1 second. I have to get everything reset up again. So don't go away, but the audio is back now. So great. I had to close everything out and reopen it all again. So just give me a second to get everything back ready again here. Never had that happen before. Something must have happened with the internet. Okay, I think we're ready. Okay. Now, MACD is a highly interpretive probability signal that is based on the differences of existing between 3 moving averages and its histogram. While it is slower than momentum indicators such as stochastics and relative strength index or commodities channel index, if you are willing to sacrifice a little bit of speed in exchange for safety, it is good at keeping you on the right side of the markets. The name is based on the lesser moving average of price continually converging and diverging. Now, what we're looking for is we start out with the 12-day and again the 26-period moving average. This then gives us our line below, and it also gives us our signal line. So first we have the difference between the 26 and the 12-day moving average, and it is plotted on the chart below. Then we take a 9-day variable of that difference, and that is plotted on the chart below. So once we have it on the chart, you end up with 3 pieces of information on your chart. I've got to move past building this. Okay. We end up with the histogram, the signal line, and the MACD line. So let's go real quickly over back to the charts. So we have the histogram in blue. We have the MACD line in red, and we have the signal line in yellow. Okay. So all that the difference is between the red line and the yellow line is the 9-day exponential moving average of the red line. Pretty simple. Okay. And then the histogram, which is the measure of the difference between the two at all times. Okay. So it's 3 simple calculations. Okay. Because what we're looking for is a reaction between these 3 variables. Okay. The 2 prime reactions are the crossovers between the red line and the orange line. The red being the signal line and the MACD line. Okay. Now, when they cross over or they converge and diverge, converge means what? Converge means coming together, and diverge means moving apart. Now, somebody keeps asking me this ridiculous question. Crossover, can you please put the crossover on the bar chart? No, there is no crossover put on the bar chart. The MACD is put below the chart. Okay, there is nothing to drop on top of the chart. This is how a MACD is placed. Okay. Now, once we have these 3 pieces of information on a chart, we have to then learn to start understanding what they're trying to tell us. Okay, so in downtrending markets, the fast-moving average will move down faster than the slow-moving average. As the fast-moving average diverges from the slow-moving average, the MACD will illustrate that relationship. In uptrending markets, the 12-period EMA should move up faster than the 26-period EMA. As such, MACD will move higher to express the growing difference between the 12 and the 26 periods moving average. The graphic will illustrate this relationship with the 12 and the 26 EMAs applied on the chart with the MACD using the 12 and 26 periods. So all that these are, okay, on the top, these are not your MACD signal lines. These are just simple moving average lines. We are not looking at the crossovers of these moving average lines. They are moving average lines, but the MACD, this is no different than using a 50 and a 20-day moving average line. The MACD is all about the calculations of those 2 moving averages, but they're not plotted on a chart because you can be using a 50 and a 20. What you're concerned with is what is on the bottom of this chart. So notice that MACD helped traders notice the trend change from the very early stages, because what we got here was the MACD line moves below the 0, and then it moves above the 0 line. The 0 line, okay, is this line that's plotted on the chart, because when you put the MACDs on the chart, they're going to give you the variations. There's some point that is 0. Okay. Because what happens is the difference between the 12 and the 26 will move from a positive number to a negative number. This is a key part of the indicator, and sometimes we will delve much deeper into this. But again, these are complex strategies. MACD will cross the 0 line as the faster moving average intersects the slowing moving average. The signal line. The MACD can be helpful for noticing potential trend changes at the very early stage of a currency pair's move. However, if we wait for a 0 line crossover, MACD to cross the 0 line, we will essentially be trading a moving average crossover, which is inherently lagging the market and may not be the optimal point of entry. This is where the signal line comes into play. The signal line is simply a moving average built on the value of the MACD. By default, the value is the common 9 periods. So we have our moving average line. So for all of you who keep asking me to put these on a chart, is we do not put these on a chart. Okay? Those are simple moving averages. They are the EMA, these are the lines that are used for calculating the MACD signal here. So you have your MACD line, which is simply the difference of these two. So the 0 is exactly where they cross over because there's no difference between those two. And then you have where they separate, and that either goes up or down. Then you have the signal line, which is simply a 9-day moving average of the difference between those lines. Okay. So the signal line is simply a moving average built on the value of the MACD. By default, this value is set in 9 periods. Building on the relationship of the MACD line itself, traders will often look for entry points when the MACD line crosses the signal line. Because if you were to use these two lines up here, all you're doing then is trading two moving averages. Okay, most people don't use 9 and 26. They would use a 50 and a 90, a 100 and a 50. There's all types, a 20 and a 10. There are all types of moving averages and moving average crossovers. But moving average crossovers usually lag way behind the market. So what we do is we take these two moving averages. You don't need to even plot on a chart. You just have number values done on the calculations, and we calculate the difference between the two and plot those down below on our MACD line. We then take a 9-day or 9-period moving average and plot that on our signal line. So when we get the crossover between the 9-day and the 26 MACD line and the signal line, that moves a lot closer, gives us a more viable signal. So when the MACD line crosses above and over the signal line, it is looked at as a signal to buy. When MACD crosses below the signal line, it is often looked at as a signal to sell. So in other words, here we can see what? We can see the MACD line, which is the red line, crosses over the blue line, giving us a buy signal. Here we have sell signals when they cross below. So what are we looking for? We're looking for a convergence or a divergence. Okay. Guys, I can't keep doing this because we're getting nowhere. I didn't say a simple moving average. I said it was an EMA, and I said it was simply a moving average built on the value. Not a simple moving average. I said it is, let's take the word simply out. It is easily a moving average, or it is readily. It's just an adjective. Okay. We use EMAs for everything here. So, in an effort to more closely follow the relationship between the MACD and the signal line, okay, as we can see again here, we have the red and the blue lines. What we do is we develop the histogram. Okay, the histogram is a simple bar chart plotted around the 0 line and indicates the relationship between the MACD and the signal line. So the histogram is simply the difference between these two lines. And then you plot it using the 0 line here. So if the difference between these two lines was a +1, we would plot it on a +1 above the 0 line. If it was a -1 because it moved the opposite, we would plot it then next to that. And then it just goes on. And what this histogram is simply a visual representation of the difference between the MACD and the histogram. So instead of having to look for the crossovers and the convergence and divergence, you can see them in a histogram, because when the histogram is right at the zero line, what's happening? The MACD and the signal line are together because there's no difference. When they move apart, they either form a negative or a positive. So the histogram will illustrate the relationship between the MACD and the signal line. When MACD crosses the signal line, the histogram will cross the zero line. When it goes the opposite way, it'll fall below the zero line. So notice in the graphic, when MACD crosses the signal line, the histogram will appropriately cross the zero line. When MACD crosses up and over the signal line, the histogram will climb above zero. And when the MACD crosses down and below the signal line, the histogram will drop below the zero. So again, all it is a visual representation of the differences of the mathematical calculations. Because most people, or most successful traders, trade from simply the histogram, because all it's doing is giving you all of these lines together in a simple, easy to see format. So the MACD proves most effective in wide swinging trading markets. There are three popular ways to use the MACD convergence divergence: crossovers, overbought oversold conditions, and divergences. Okay. The basic MACD trading rule is to sell when the MACD falls below its signal line. Similarly, a buy signal occurs when the MACD line rises above its signal line. So as you can see on the chart right here, when we have the crossovers going down, so with the MACD is in the black and the signal line is in the red. So what happens? The MACD crosses below its signal line. What does that tell you? Okay. When MACD falls below its signal line, is a time to sell. When we got this crossover right here on this chart, what happened with price? Price continued to decline. I'm sorry, let me go back. Okay. When we got the opposite respect over here, okay, and the MACD line crossed above its signal line, here, we got a buy signal. What happened here? The market moved up to buy. Each time, so what we're looking for is the relationship of that, or we can see it on the histogram. What happens? You're looking for that divergence, but what happens? Price moved down here and hit the zero line. That zero line tells you all it is a representation of this calculation, because in order for them to cross, they must hit zero, because they must be the same price. So if the histogram falls below, or the histogram climbs above. Here it fell below, it was a sell signal. Here it hit zero and then climbed above, it's a buy signal. So all it is a more concise, easier to see variation of what all those lines are doing on your charts. Because when you're looking at many, many different lines on your charts, and you have many different indicators, sometimes you want to get as few little things that you have to look at as possible. You want a clear-cut, easy route. So here your histogram is simply a visual representation of the difference in the movement of these two lines. So again, we can see that right here. The MACD crossed below. It gave us a sell signal. The market's dropped down. The MACD crossed above and moved up, gave us a buy signal. Moved into an uptrend. Again, the exact opposite. And you can see them each taking place. Now you had the crossovers, okay, but instead of doing the calculations, because also you can start seeing patterns in that histogram. Because look at that. the farther and the bigger that histogram got, the more steeper that the price decline was. So MACD is also useful as an overbought and oversold indicator. When the shorter moving average pulls away dramatically from its longer moving average, the MACD rises, it is likely that the symbol price is overextending and will soon return to more realistic levels. So in other words, it's telling you the market is overbought. Then the third way it is used is for divergence, an indication that the end of the current trend may be near. Let me clear this stuff off. An indication that the end of the current trend may be near occurs when the MACD diverges from the symbol. A bullish divergence occurs when the moving average convergence divergence indicator is making new highs while price fails to reach new highs. So in other words, what we're seeing is the signal line. You see here, you actually can put a line across or build a trend line on your MACD line. Okay, and your MACD line, even though it's moving up and down, it's making higher highs because it didn't fall as low as this low that it had here, fell up here. But price, on the other hand, isn't climbing up. These two lines are diverging. See how the moving average here, the MACD line, is on an up angle, and price is in a down angle. What is that telling us? It's telling us we have a divergence. So a bullish divergence occurs when the MACD indicator is making new highs while price fails to reach new highs. So here it's making new highs. Price fails to make new highs. Okay. A bearish divergence occurs when the MACD is making new lows while price fails to reach new lows. Both of these divergences are most significant when they occur at relatively overbought or oversold levels. So this is three different ways to use MACD. We've got one, convergence. We have two, overbought and oversold. We have three, divergence. So here we can see the exact opposite of what we saw on the other chart. We see a bearish divergence where the MACD is actually moving lower while price is making new highs. So a bearish divergence forms when the security records higher highs and the MACD line forms lower highs. The higher high in a security is normal for an uptrend, but the lower high in the MACD shows less upside momentum. Even though upside momentum may be less, upside momentum is still outpacing downside momentum as long as the MACD is positive. Waning upward momentum can sometimes foreshadow a trend reversal. So in other words, we have higher highs and we have an uptrend. Okay. But because the MACD is not climbing in the same direction, what it's telling us is the strength of that move is easing. So that's telling us not that you're going to have a reversal right now, but that is a foreshadow of a trend reversal. Now, we can simply do all this using the histogram. Okay. So the MACD histogram is an indicator of an indicator. In fact, MACD is also an indicator of an indicator because first of all, MACD is an indicator of two exponential moving averages. Then it's plotted as another indicator, and the histogram is simply an indicator of that indicator. So first we derive very simply, again, the 12-day EMA and the 26-day EMA. Then we take the second we derive, so we have the 12-day EMA and the 26-day EMA. Then we have the 12-day less the 26 because that forms the MACD line. So we start with the 12 and the 26. We then subtract them to get the MACD. The third derivative is the MACD signal line, which is a 9-day EMA of the MACD. So the fourth derivative is the MACD histogram, which is the MACD less the MACD signal line. It is this number minus this number plotted on the histogram. So the base for this indicator is the securities price. It takes 4 steps to get the actual price to the MACD histogram. Talk about massaging data. Well, not necessarily a bad thing. Charters should keep in mind that when analyzing the MACD histogram, it is an indicator of an indicator. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to identify changes in the price momentum of the underlying security. Okay. So you follow that? 12-day and 26-day EMAs. Then it is derived, or becomes a derivative, and forms the MACD. It's the difference between the 12-day EMA minus the 26-day EMA. That gives us our MACD line. Then we get to the third, and we take the average of the MACD line, which is the difference between 12 and 26, and that gives us our signal line. And then we take the difference between the second derivative and the third derivative is plotted on the histogram. So the histogram is just simply the calculations of all the other calculations. So with the MACD, and the MACD histogram is also designed to identify convergence, divergence, and crossovers. The MACD histogram, however, is measuring the distance between the MACD and its signal line. The histogram is positive when MACD is above its signal line. Positive values increase as MACD diverges farther from the signal line to the upside. Positive values decrease as the MACD and its signal line converge, and the MACD histogram crosses the zero line as the MACD crosses below its signal line. So actually all it's doing is plotting the difference between the signal line and the MACD line to give you the difference. When it's above, it's converging. I'm sorry, when it's above, it's diverging. When it's below, it's converging. Okay. And therefore, you can actually see everything that you saw in all of these derivatives simply in the histogram. Now, it has become standard to plot a separate moving average alongside the MACD, which is used to create a clear signal of shifting momentum. A signal line, also known as a trigger line, is created by taking the 9-day EMA of the MACD. Now, the MACD bullish signal or buy signal occurs when the MACD line, the solid line, crosses above the signal line. So when you have a crossover above, it's a buy signal. A crossover below is a sell signal. Okay, in the previous, the various signals generated by this indicator are easily interpreted and can quickly be incorporated in any short-term trading strategy. At the most basic level, the MACD indicator is a very useful tool that can help traders ensure this short-term direction is working in their favor. Okay. You can plot MACD on any time frame you want. You have to determine what time frame fits the trading strategy you are using. Okay. But MACD is one of the few indicators that works good in short-term trades. So whether you're using a 15-minute chart, a 30-minute chart, or 1-hour chart, it works just as well. There's lots of indicators that don't work well in short-term markets. The biggest disadvantage of using this indicator to generate transaction signals is that a trader can get whipsawed in and out of a position several times before being able to capture a strong change in momentum. As you see in this chart, the lagging aspect of this indicator can generate several transaction signals during a prolonged move. This may cause a trader to realize several unimpressive gains or even small losses during a rally. Traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets because relatively small movements can cause the indicator to change directions quickly. The large number of false signals can result in a trader taking many losses. When conditions are factored into the equation, the strategy can become very expensive. So another MACD drawback is inability to make comparisons between different securities. Because the MACD is the dollar value between the two moving averages, the reading for different price stocks provides slight insights when compared to the number of assets to be traded. So what you need to do is you need to find the assets you're trading, watch how MACD works with those, watch what the variations are to plot them. But basically in the currency markets, they work the same. In the commodity markets, you have to come up with a slightly different determination. Stock market, again, because the stock market is a much slower moving market. Okay. The MACD indicator is the most popular tool in technical analysis because it gives traders the ability to quickly and easily identify short-term trend direction. If there were ever a quest in the world for investing on par with the search for the Holy Grail, it would be acquiring the ability to spot trend changes. There are many ways investors attempt to do this with varying degrees of success, but a common trend tracking tool is two-line moving average convergence divergence MACD. Okay. Now, this tool will help you spot trend reversals and market reversals. Okay, I won't buy or sell on a buy or sell entry signal from MACD. I will use it in conjunction with other indicators because it does give you false crossovers, and you have to verify this with more. So if you're using Japanese candlesticks, you would want to see some type of pattern, whether it's a bullish divergence or a bearish divergence, something that will give you a entry signal at a price. Because remember, with a lagging indicator slightly behind the markets, and it can give you false signals. So it's going to alert you to an entry type position, but not necessarily tell you to trade that position. So keep that in mind. No indicator will stand on its own, and MACD doesn't. But momentum in charting is similar to momentum in physics. If you throw a ball in the air, it will ascend at a slower and slower pace the higher it projects. After monitoring the change in momentum, a person can determine when that ball will stop climbing and change direction and descend. So remember, you throw the ball up 3 or 4 times, you're going to know with the momentum you threw it up how high it's going to go and where you're going to expect it to arch back down. And this is basically what this indicator is telling you. Okay. So just like in physics, momentum changes occur before the price of an asset changes. Now, there are many ways and there's many strategies out there that people have developed for using MACD. So they have channeling MACD. So as you can see here, a lot of people will plot the channel of how the MACD is moving. Or you can plot how it looks on a histogram. Okay. We saw before the lower lows and the lower highs on the MACD as compared to the trend on the charts. There are all different ways of doing it, but these are all different uses of this indicator. First, you have to understand the indicator, but then you can combine it with other things. The strength of the current trend can be measured by channeling the MACD. Spot trend reversals by looking for divergence in momentum, as well as measured by MACD channels. Determine buy and sell signals using MACD crossovers or bounces. Learning to implement and recognize these signals helps investors increase their profits when trading short-term or intermediary-term trends. So overall, MACD is very reliable at indicating a trend reversal or the end of a trend movement. Okay. The rest of it you have to take with a grain of salt. Okay. But you can use the MACD histogram to give you both entry and exit points. But again, you have to learn how to use them. But like life, trading is rarely black and white. Some rules that traders agree on blindly, such as never adding to a loser, or can be successfully broken to achieve extraordinary profits. However, a logical methodology approach for violating these important money management rules needs to be established before attempting to capture gains. In the case of the MACD histogram, trading the indicator instead of the price offers a new way to trade an old idea, divergence. Applying this method to the Forex market, which allows effortless scaling up of positions, makes this idea even more intriguing to day traders and position traders. But again, all we're trying to do is get you familiar tonight with MACD. MACD, I mean, it's going to take you months to learn and months to master. Okay, you understand what the lines are, how they're derived, what they can tell you, what they can possibly, but now it's how do you use it in your trading strategy. And that becomes very personal. And this is how you would use it, but there's a million MACD trading strategies out there. If you just do a quick internet search of MACD, you're going to see all the strategies you can possibly want. Okay, you can decide which ones you want to try, which ones you want to test, and then which ones you'd like to incorporate into your trading plan. So again, thank you very much. Have a good night, and thank you for supporting Prime as well as being part of the Investor.com family. Good night now.